Welcome to both our HLB community members, as well as the many Australianbiz guests who are also joining us today. Look, for the Australianbiz guests who don't know me, I'm Tony Dickens. I'm the Professional Partnership Executive here at HLB in Sydney, and I have specific responsibility for managing the HLB community of metropolitan accounting firms. I'll touch briefly on the HLB community and the Australianbiz at the end of the presentation. We're delighted to partner with Joe Caleb in Australianbiz today to present the webinar on selling a small business 5 ways to save using the CGT concessions. As the invitation noted, Australianbiz is a small information website used extensively by accountants and other SME advisors across Australia. Joe's worked on and off for over 10 years with our presenter today, Peter Bembrick. Peter, who many of you will know, has been providing tax assistance to businesses and individuals since he joined HLB 30 years ago, becoming a partner in 2004 and currently chairing the firm's Australasian Tax Committee. Peter's highly regarded and his opinions are widely sought after by industry and peers. He has served on advisory committees for Chartered Accountants Australia and New Zealand, and he's written numerous articles for business publications.
Thank you, Tony. Welcome, everybody. We appreciate so many of you joining, and I'll add my thanks to Tony's comments to Joe. I appreciate. I've known Joe for many years, and he's been a good friend of the firm. So I certainly appreciate the opportunity to tap into all of the Australianbiz contacts as well. So as Tony said, what we're going to go through today is the small business CGT concessions. I'm sure a lot of you are familiar with, and looking at ways to save when selling a business, and with a particularly a case study focus. So I'll start by going through a few of the basic eligibility requirements, just as a refresher to all of you. And then I'll use these 5 opportunities or case studies to illustrate some of probably the most common and certainly most useful elements of the concessions and ways to use that we can find. That I find that we can use the concessions to in different scenarios. So I'll talk through those case studies, and you may have more questions. And as Tony says, with the number involved here today, we'll address the questions towards the end, and I will particularly focus on questions that are probably more closely related to the issues that we're discussing, because this is such a broad topic. We could probably cover a lot, but we'll see how we go with the questions. But I'll try and just keep to time, and we'll keep working through these case studies. So starting at the beginning, the basics. So Section 152.10, as many of you are probably aware, sets out quite a number of basic conditions. There's a lot of boxes to tick to get through to the small business CGT concessions and apply them to a client situation. So probably the ones where you really need to start is aggregated turnover or net asset value test. So again, often so $2 million is the aggregated turnover test, which would make something a small business entity, and that certainly can apply in certain situations. Or if that doesn't qualify, and there's a few conditions that make that test difficult to satisfy, then I find that probably more commonly we're looking at the $6 million net asset value test, and that is one of the things I'll cover as to what some of the complications are, and what will make it perhaps sometimes a bit tricky to satisfy the test. But that is definitely a very big threshold condition. There are a number of others, but one of the most fundamental concepts that we'll illustrate through today is there has to be the sale of an active asset. So we're talking about a business sale here, not a passive investment vehicle, not something that's perhaps a mix of business and passive assets. It's very important that the asset being sold qualifies as an active asset, and I'll talk a bit more about that later. Okay, so firstly, what is an active asset? So most obvious examples, land. If you're actually selling land directly, when I referred to the $2 million net turnover test, one situation that I've advised on is where somebody actually owns, say farmland directly. So the values might be more than 6 million. So we're not the net asset value test doesn't really help. But for various reasons, the turnover of the business carried on as a sole trader may be less than 2 million. So, so a direct sale of land certainly qualifies, or if we're looking at assets within an entity that you're selling, then one of the active assets could be land and buildings, equipment, all the things that you would expect perhaps might be used in carrying on a business. Then you've got on the right-hand side intangibles. Often it is simply the bulk of the value by far of what they're selling is the goodwill that they built up. But there can also be things like copyrights, registered copyrights, patents, other intellectual property like software. Because these days people developing software, that may well be where a lot of the value of the business lies as well. So all of these things can be active assets, which is defined as an asset that the taxpayer owns and uses or holds ready for use in the course of carrying on a business. When selling shares in a company, there's also what you might hear of as this 80% test. So at a particular point in time, the shares themselves will be active if the market value of the active assets within the company is at least 80% of the total market value of the company's assets. And that's just looking at gross assets. We don't need to consider liabilities in that case. So I'll move on to the case studies. So the first one I'll look at is active asset versus rental income. And that's because there's an important carve out. Something might arguably qualify as an active asset, but there's also a carve out in the relevant section for an asset whose main use is to derive rental income. So so that sort of gets around the question where you argue, well, this is in the business of rental. You can be, and for income tax purposes, that may well be something that helps, that the scale and nature of an activity is that you're carrying on a business of rental. But if you're not actually, if the main use is actually to derive rental income, then it still won't qualify as an active asset. And that's where some of the best guidance in this area is the ATO has a determination, TD 2006-78, which goes through a number of some of the main principles and a number of examples. And there's also various sort of private rulings in the ATO's register that addresses this. So I've just pulled from that one example is, so we have Chris here who owns Eagleton Storage Solutions, which is something that offers commercial storage space. So he has, and this is where they look at situations where you might argue, is this really rent? Is it really rent, or is it more of an active activity? And sometimes it's obvious, sometimes perhaps less so. So in Chris's case, we had a facility that has 50 storage sheds. The hire periods can last from 1 week up to as long as 2 years or more. So you can see it's on one end of the scale, it's short-term storage hire. Chris would certainly argue that's not rent, that's more of a business activity. But you could also have you might have a long-term tenant, he might even call them tenants in the agreements and in the way that he deals with them commercially. Somebody could be there for many years and using the same storage unit. Is that rental? And so they go through a number of, the ATO and the determination goes through a number of different examples of situations to analyse these points. And some of the key, and there's a number of key factors they focus in on. In Chris's case, and there are some other services being provided. So on-site, there are office facilities, on-site security, equipment, perhaps either made available either for sale or loan, associated with with using the storage facilities. And one key point, well, two of the key points, the bottom 2 points there, under the storage agreement, they can be the tenant or the client customer can be relocated to another space. And Chris also has the right to enter the client space without their consent, which you might get a different outcome if they were, and perhaps more likely to be considered to be rental if they were clearly had their own guaranteed this particular storage unit, and Chris had to seek the client's permission in order to enter, and also the exclusive access is a very key it is quite an important point. So if there wasn't exclusive access, that would make it less likely as well. So so that is a plus. So there's a few pluses and minuses there, but this is leaning towards the sort of scenario, the example that the AHO has, where they suggest that this facility can be an active asset, but there are other factors where they lean toward where they would suggest that it may not be. They cover things like boarding, just to other scenarios. They cover things like a boarding house. It's that where it's more that short-term use, ability to enter without permission. There's not exclusive access. They can be relocated. All these factors, where the AHO says, well, in that situation, they will accept that it's not rental, as opposed to something that's more like a rental property. And there's a few other situations like that, and so it's one that I've also looked at is shopping. It's a shopping centre. You might think, and there's been a number of people who have applied for private rulings on a shopping centre. You might think that a shopping centre could be considered to be, because of the scale of it, the extra facilities and common areas that are provided by the owner of the centre to tenants. You would think that there might be a chance that could be considered to be an active asset. But the ATO's view is that they've expressed in certainly a number of private rulings, it probably hasn't been tested as fully as it could be, that they would say, well, they've got exclusive access to their particular shop in the centre, and they're basically like paying rent. So it could be a bit of a grey area, and it's very fact specific. So I might just move on from that, and I know there'll be some questions coming through already, which I'll probably on this that I will come back to at the end in order to make sure that I get through this. So I'll just change tack to a different area. We talked about an active asset. So an active asset it generally has to be used in a business, but one area when you dig deeper into the definition, it could be used by the owner of the asset in the business of their own business, or of the business of an entity that's connected with them, or an affiliate. So it's a bit of a broader thing there. And so then there is a special rule which talks about spouses. So this is the example I've got here. Andy is a children's entertainer, writes and records music, rehearses for performances in the course of his business. So if he owned a property, he's using it for his business, for his business. It's his studio, rehearsal space. He would treat that as an active asset. His wife, probably a fairly common scenario, his wife, April, actually buys the commercial properties and leases it to Andy on arm's length terms. Normally you would say, well, April owns a property, it's passive, it's for rental, it's not an active asset when she sells the property. And in fact, normally Andy they're not connected entities, and Andy would not normally be her affiliate. It's the definition of affiliate specifically excludes spouses in the normal situation. So this section here actually, and you go specifically to section 152.47, it talks about that will be in a situation like this, April will be deemed to be Andy's affiliate, and that is a bit of a double-edged sword. It allows the asset to be treated as active because they'll be affiliates. Therefore, it will be, and from April's perspective as the asset owner, it will be used in the business of an affiliate, which is Andy, to carry on his business. So there is that connection there. The double-edged sword is that it also then means that they'll be, if they're applying, say, the turnover test, or particularly the $6 million net asset test, it sometimes helps to have spouses not being affiliates, and so that sometimes reduces the scope of assets that need to be included in the test. But once they're deemed to be affiliates, then that will potentially broaden the scope of assets that are pulled within the $6 million test. So so if they're on the cusp of breaching the test, that might count against them, but it's certainly the only way that in this example that they can get the concessions. The second question I have there in that example is if the usage is mixed. So if there are some external tenants, and there's the ATO again has covered this, and there's been case law, and they've looked at there's a couple of different ways you could do it. You could possibly look at this as a land area. If you know 80% of the land is used in the business, that would be one. You know, is that enough, or you know, what the revenue. So generally they're looking at, well, so it's the so generally they tend to look at more at the land area. So as the but you could argue it's the sort of the revenue as well. So there's a few different ways this could be looked at, but it's certainly the point there is its main area of use is what main purpose is what they're trying to look at. And then if you can get main purpose as being in business, then that allows the active asset test to be satisfied, which in turn allows the concessions to be claimed. So that's really the main points I wanted to make there. I'll just move down to the other concessions, and then maybe the third one has a little bit more. The third and fourth ones probably have a little bit more detail to them that we have to just sort of talk through to try and keep this as simple as possible. So so we have here a I'm now looking at the $6 million net asset test. So yeah, so this goes over 2 slides. I'll start with this one. It gives you the picture, and might also give you the theme for where some of these case studies, if you share my tastes in lockdown streaming shows. But so we have here a company called Pawnee Parks and Recreation Proprietary Limited, which is owned by 3. So we've got 3 unrelated parties here owning. So it's certainly not uncommon to have 2 or 3 owners, perhaps, of a business, as opposed to one family owning the business. And it's also fairly common, as I'm sure you will all have, that to have family trusts owning the shares. So within this basic structure, we've got some facts here about each of the 3 families and how they own their shares and whether each of them qualify. And it's important to bear in mind that if we're selling this, we're going to sell the shares in this business, as opposed to selling the business assets. There's going to be a share sale. So each of the families, so the main individuals here are Leslie, Ron, and Donna, and their spouses in the case of Leslie and Ron. So the 3 of them will be selling their shares individually through their family trusts. They're separate CGT assets, separate transactions. So it may be that some of them qualify for the concessions and some don't. So you just need to look at it that way. And that could be based on one of them having a couple of factors, including the assets within the trust, and also the way the distributions are made, and and also whether in terms of, we're focusing here on the 6 million test, so whether one of them might simply have too many assets in addition to. So the first thing to consider with the $6 million test is, and I'll address the questions down the 2 companies down the bottom too. So PPR there has 30% interest in another company, Craig's Vegan Grocery, and 15% of Tom's Bistro. So I'll discuss the reasons for those being there, and there's some that all comes from some changes that were introduced in 2018. There were some quite significant changes to these rules in 2018 that made it in a lot of cases more difficult to satisfy the tests. So, but the first point I will make then in analysing these facts is that it's necessary that when you're selling shares in a company like Pawnee Parks and Recreation, that the value of the total value of that company, the assets in that company needs to needs to not must be, you know, no more than $6 million, the net asset value. So it used to be possible before 2018 for, say, a $15 million company to be sold, and if you're selling the shares, each of the shareholders, as long as they didn't have a controlling interest, say take Ron for example, as 30%. 40% is generally taken to be control or connected. Connected entities when applying all this would be the Ron Family Trust, certainly under the previously would not be considered to be connected with the company if because it's only got a 30% interest. So previously all he had to worry about was his own 30%. And if it was 30% of 15 million and that kept him under the 6 million, then he still had a chance there under the concessions. So once the value of the company, since 2018, once the value of the company goes over 6 million, then they're already eliminated from, there's no chance of going any further. So you need to be conscious of that. But assuming that, I think we've got, so yeah, so we're selling the company for 5 million, just keep that in mind. So we've ticked that box. If I then talk about the connected entities, so as I was just saying, Ron's Family Trust only owns 30% of the company. Likewise, Donna's Family Trust only owns 25%. So those trusts are not connected with Poyney Parks and Recreation. So it's not that they don't need to. When the Ron Family Trust is looking at the concessions to its sale of its shares, it doesn't have to include all of the value of the company. It only has to include its 30% share as an asset, along with the other assets that it has, and then look at how you apply the test from there in terms of, and I won't necessarily go through every single aspect of the conditions, but in terms of the $6 million testing, they're probably the key points there. And some people have, sometimes companies might have, a family trust might have other assets in there as well, properties, share investments, or maybe an investment in another business. So you need to consider all those assets in the trust, but certainly the shares in the company is a key asset. For Donna, it's a very straightforward analysis because she owns 25%. So again, likewise, she's not considered to be connected with, or she doesn't control that Poyney Parks and Recreation. She's 100%. She's the only one who received distributions. So when you trace in distributions for other aspects of the analysis, then it's pretty clear how that works. Leslie's is the interesting one at this stage because owning 45%, then the Leslie Family Trust has that connection. It's a connected entity. It's an indicator of control. So the entire value of when Leslie's looking at the $5 million test, the entire $5 million, the $6 million test, the entire $5 million of the company's value gets added to any other assets that are in the trust. And for that matter, then you're looking at potentially if Leslie as an individual is connected entity of the trust, then she probably is based on these distributions. Then it'd be assets that she owns in her own name as well. So you sort of need to look at the whole picture there. But I won't go into any detail, but just that's who you're looking at to connect with. In any case, if Ben's only receiving a small percentage of distributions, he may not need to be connected with the trust, because he won't be a connected entity of the trust necessarily. And whereas say Donna will be connected with her trust, so if she owns assets in her own name, she'll need to add those in as well as what's in the trust. So before I get to the companies at the bottom, discretionary trusts are interesting because, well, there's things I'll get to. The discretionary trusts are interesting because you need to look at a pattern of distribution. So if you had a company or a unit trust, it would simply be based on the unit holding or the shareholding percentages. With a discretionary trust, you're looking at there's a pattern of distributions test that applies for the 4 years prior to the sale. This is a 2023 year sale, and we're looking at so if any individual beneficiary gets to over the 40% mark in terms of the pattern of distributions, then they would generally consider to be a connected entity of the trust. So if we take, so Leslie's hasn't changed, so and Donna's. So as I said, it's pretty clear there. Leslie is 85%, Ben is 15%. So Leslie will be connected entity of the trust, Ben won't. So you won't have to look at any of Ben's personal assets, but you'll have to look at all of Leslie's personal assets, excluding, again, just to probably cover a basic point, the family home and any balances in superannuation are always excluded from the $6 million test, remembering that, but anything else you have to look at. Same with Donna, clearly anything that she owned, as I said before. With Ron, we'll have to do that pattern of distributions over the 4 years. So for the 22 year, 22 and 21, in fact, Ron clearly exceeds 40%. So Ron will definitely be a connected entity. So any assets that Ron owns personally will be added to the total net asset value in terms of looking at whether they exceed 6 million. Diane is a spouse. She actually won't, even though she's got 40% in the 21 year. If one beneficiary has 40% and another one has, say, 60%, or has a more, so you can basically say that Ron in that 21 year, you can say Ron controls and Diane doesn't, then it would be possible to say, well, Diane is not necessarily, she may not need to be included. But I guess one of the difficult ones is, and Andy as a 25-year-old son is okay as well because he's less than 40%. One of the difficult ones is Tammy, Ron's former spouse, back to 2019, obviously when they were still married, received 45%. So in that 4 year period, she did actually receive 40% in any 1 year, which even though it was the furthest back year. So there's nothing stopping actually Tammy's assets being caught in this test as well, which seems a bit maybe a bit harsh, but so definitely Ron's assets and Tammy's assets would be covered by this. So so it's just something that would probably be a bit problematic and probably maybe could some practical issues, but it's something that Ron will need to consider when he's selling his shares. With the Leslie Trust, another point we've got there is an alternative test with the discretionary trust is who would be considered to either control in the sense of if the trust would act in accordance with the wishes of somebody, so they can sort of exercise control whether they've actually been receiving distributions or not. That's a separate test. Some would say the appointer it's not the trustee because the trustee can easily be changed. Some would say the appointer arguably has an element of control. I know some have disputed that, saying that the appointer doesn't really exercise day-to-day control. All they do is change the trustee, which certainly gives them an element of control. But there's also been, to the extent the appointer is relevant, there's also been case law that says where they had 3 appointers and they had to act unanimously. So in that, it was certainly considered there that if Leslie on her own couldn't make any key decisions in a role as appointer of the trust without Ben and her sister Anne agreeing, then none of them on their own probably would actually be brought in. Certainly Anne doesn't appear to have any other involvement in the trust, shouldn't get dragged in just because she has that role as appointer. She doesn't otherwise have exercise any control. I'll go through again. I'm sure this might have prompted a few more questions, or it might at the end. But the last 2 companies there, that's intended to illustrate one of the changes that was brought in 2018, where companies below, when you work down from the target company, being Borneo Parks and Recreation, there's a test which is very similar to the connected entity, the 40% connected entity test above it, but with a 20% threshold, so that if, as in this case with Craig's Very Vegan Grocery, there's a 30% shareholding, which is more than 20%, then it's effectively deemed to control the Craig's company there. So he will they'll need to include the entire value of Craig's Vegan Grocery in the calculation in the assessment. So that might affect some of this further up. You need to flow that up in terms of, it won't be just the 30%. It won't be just, the $6 million, the $5 million value of the Pawnee Parks and Recreation shares. You also have to factor in the entire value of Craig's, even though they only own 30% of it. But by contrast, Tom's Bistro is only a 15% shareholding, so they don't meet that 20% threshold. So it'll only be clearly the 15% shareholding in Tom's, whatever that's worth, will already be factored into the value of Pawnee's shares, so that there won't be any adjustments required there, but there will be for Craig's. So just a couple of things that need to be, so it become quite, and I'm sure that there's very many other twists and turns that can arise with this sort of thing, but and you could have a 50-50 shareholding. That's quite a common one between two family trusts. So in that case, both the 50-50 shareholders will clearly own both, and they'll have to include that they'll both control. They'll have to include the value of the entire company in their calculations, and it will come down to whether there are a lot of other assets that the family trusts and the relevant individuals own themselves, which certainly seen one example where one of the two owners had that structure. They'd had that structure, and one of the two owners had a lot more of other assets than the more junior owner or the younger business partner. So the older one had absolutely no chance, and he wasn't even considering it. The best he could get was, at least by selling the shares rather than the assets, he could get the 50% discount on it and selling his shares, but he knew he wouldn't get the CGT concessions, whereas his business partner, who didn't have a lot of assets, could actually do that. So, and I think actually I might touch on that further down. So I might just leave that point there. So Jerry and Mark have a company, and this is what I was focusing on here, was really selling the shares or the business assets. So, and as I was just starting to say with that other example, this is the sort of example where they own two, they're the 50-50 owners of the company. It's been operated since 2010, and they have 50% each, and through their family trusts. So they sell for goodwill value of 3 million. There's goodwill value of 3 million, premises value of 2 million, and then there's some various things on the balance sheet. So there's some loans from each of Jerry and Mark, 150,000, which will have to be repaid to them. You've got Jerry and his wife Gail, who are both age 56, while Mark is single and age 43. So you can see some differences in their profiles. So they might want different things from this sale. However, unlike Jerry, Mark has significant non-business assets which are held in his family trust. So that's now Mark's family trust is his vehicle of choice, I guess, and so he has all these various investments in that, including his share in the business. The purchaser is looking to buy the assets, but they can do a deal on the share sale with a 10% discount. And the question is it sufficiently tax effective to make that worthwhile? And probably something that they will look at. So what does the balance sheet look like? So we've got cash and debtors, plant and equipment there, land and buildings. So there's a bit of, I guess, obviously this is what the balance sheet look like. You've got creditors and accruals, and some retained earnings. So they'll need to they might need to clean this up a little bit, and they'll have to. So obviously the key question is, what do they need to do to apply the concessions? So, and as I was saying, this is the structure. So if Mark would be he's not going to exceed. He's going to exceed the $6 million. He's just got way too many assets. Jerry can still get it. But certainly a share sale would work for them. It would give them the CGT discount, which is certainly beneficial. It would certainly allow Jerry to claim the concessions, even if Mark doesn't. So that's where I've seen in a real life example that has been the decision that it'll benefit. Even if it'll have one of the shareholders, it's a deal that's worth doing. Combined with the benefit of the CGT discount there, and obviously cleaning up a few things like cleaning up the loan account, and if there was and perhaps if there was a issue with the valuations, if they were going to exceed the value, they could potentially pay out. Might need the cash. The issue would be and if there was cash, they could potentially look at paying dividends. So there's but as you can see, there isn't an awful lot of cash there. So even when they collect their or they collect all their debtors, pay out creditors. So it's so there's probably not a lot they can do in terms of mixing up the balance sheet. But in some cases, if there is a bit of cash and profits there, one way to help the situation if the valuation was going to be a problem would be to maybe tie up the balance sheet, get some things out. Could come at a tax cost, but it's then what are the overall tax benefits? So that's probably the main thing I wanted to say there. So and when we've looked at this in a more detailed way, selling the shares in most cases tends to give more benefits. But again, that's that commercial discussion around can we sell the shares, and or does the purchaser only want the business assets? And so you've just got to weigh those things up and see how much difference it makes. And is that 10% discount that they have to give just sell the shares actually worth it? And it probably is, but again, you've got to just weigh that up. So with a 15-year exemption, and this is, as most of you would probably know, this is the best concession exemption you can get. The others, you can still get a pretty good outcome, particularly for people over 55, with a combination of the other concessions, like including the retirement concession. But the 15-year exemption certainly makes things a lot can give you a lot better outcome. So so in this case, what we have is again, this is a company here that Ron has. So the Pawnee hardware store is something that Ron has operated for 20 years. His knowledge and expertise are well known in the area. He's 63 and probably feeling that the time might have come to sell. And Ron has a good structure. He has the family trust owning all of the shares in this company, and has done for the last 20 years. The business uses leased premises, so where the bulk of the value here is in the goodwill. There's not really a lot else to maybe some plant and equipment in there, but so I think there'd be no question that the 80% test should be satisfied in terms of that the active asset. And I should probably just say that when you're looking at that 80% test, if you think back to earlier towards the beginning of the presentation, it's what really throws that out, assuming apart from necessarily literally like things like and even if it's not being used as an investment vehicle with say something like an investment portfolio, assuming it's just a business entity, the thing that generally throws that out is having a lot of cash. It's probably not a problem for most people, but most businesses. But if there's just too much excess cash there, and it would be very subjective determination by the ATO to say, well, how much is it's cash that's surplus to the needs of the business, which is probably a bit of a very subjective concept. So, but that would be something you'd want to watch. There hasn't been that, and also the really big one is Division 7A loans. If there is a history, even if they're being managed under Division 7A, the fact that there are large debit loan accounts owned by the owners and the family members to the company, that would certainly not be considered to be a business an active asset. So that could throw out the 80% test. So we'll say that Ron has none of those things, and normally you're looking at whether they meet the active asset test in the at the well, it's the common thing is it's well at the time of the sale, certainly in the relation to the 15-year exemption, it needs to be for 7.5 years, or half the lesser of 7.5 years, or half the period of ownership. So it's typically that's generally the thing with the active asset. So when you're looking at 15 years, it's going to be more than once you get to the 15-year mark. If you get to 7.5 years or 8 years, then you're fine. So so it is going to be necessary to look back over that period and seeing, well, have there ever been any big Division 7A loans, for example? So had situations where there's been, in fact, maybe in terms of we maybe haven't had all the balance sheets going back every year, and there might have been 2 accountants ago that the accounts from 15 years ago were actually done. So it's a matter of having access to that. But in any case, that assume that that's all fine with Ron, and so he works in the business. His wife Diane also has a part-time administration role. So under the agreement, Ron agrees to reduce his hours, has no major management responsibilities, and will work on, there's usually some sort of transitional period. In this case, he'll work on for around 2 years to pass on his experience, transition key relationships with trade customers, suppliers, even the employees, make sure everything just is a smooth transition. So so one of the questions I've had, and I've actually just very recently got I'm advised on a transaction that we've only just in the last few days got the favourable ruling back from the ATO. So if I was giving this presentation a week or 2 ago, I'd say it was still pending. So this is the concept of connected with retirement. It's an important one. So that's in order to, strangely, the retirement concession itself doesn't actually you don't have to be retiring. So it's slightly misnamed there. But for the 15-year exemption, the relevant individual, in this case Ron, needs to be aged over 55 and retiring, or needs to be in connection with his retirement, which doesn't necessarily mean retiring completely. And this is the point here, and it's very similar to the situation I've had with this other business sale, that they also had a 2-year transitional sort of period, which is still in progress at the moment. But they've had the sale; it's all been signed off. All intents and purposes, they're no longer. So when this goes through, Ron will not be the he won't be the boss of this business anymore. He won't be managing it. He'll just be working and doing this transition, and he should be working less hours. In the real life example, but this is sort of loosely based on, the former business owner is still working a reasonable number of hours, but he's not. It's nowhere near what he was earning. And if you could say if you're working a 30 to 35 hour week as an employee without too much management responsibility, it's a lot different to theoretically working maybe a 40 or 45 hour week, performing your key core service roles, in Ron's case, running the hardware store, maybe working in the hardware store, but then there's all the other management responsibility that goes with just being a business owner, and so the real hours that he works, including things that he does when he's at home at night and on weekends, are probably way more than that. And there's 2 aspects. There's also 2 aspects in the law. It's a change in it. It's a significant reduction in hours, or a significant change in responsibilities. So the ruling application we put on was sort of 2-pronged. Either we believe there's a significant reduction in hours, or if not, then at the very least there is a significant change in the responsibilities. So, and the ATO essentially accepted both points, that in those particular facts, and obviously private rulings are always very fact specific, but in those particular situation, which should apply to something like Ron's situation as well, it should be connected with retirement and tick all the other boxes. Then you should be able to apply the 15-year exemption to Ron's sale of shares. or the sale of shares by the family trust. And then Ron and his wife and Diane will be the relevant CGT concession stakeholders, which will be then, they'll be then receiving the tax, they'll be able to receive the tax-free payments through the trust. And just as importantly, there is not only just does the sale tax-free, but that allows a significant payment into superannuation. So the current threshold, I believe that cap is around 1.6 something million, and that can go, that amount can go in on top of the normal non-concessional caps. It doesn't have anything to do with the normal non-concessional contribution caps. It also can go into the super fund regardless of how many or how much they've already got there. It's not, they're not limited by the normal cap. No, they're still limited on how much can be held in a tax-free superannuation pension fund. It doesn't change that. But if you get more money into super, it's still generally a more tax-effective place to have your money. So if that's, and obviously there's a lot to be considered there, and I'm certainly not a financial advisor, so and if we're talking to clients about this, I'll use our wealth management and superannuation team to be part of that discussion. But if the clients are looking to do that, put more money into super, if that's their strategy, then this is certainly one way to help them boost their super fund balances. So this is the key point. And so this is part of the point of this example, really, was to illustrate that this is an issue. When you look at guidance, there isn't actually an awful lot of guidance from the ATO, which is one reason why in the other example, we went for the ruling to get a bit more certainty. It's clear that there's a bit of flexibility, to retire immediately as long as it's a plan towards retirement. If it was 6 months, that seems okay, but it wasn't clear to us from the available guidance whether 2 years would be accepted. But the ATO have accepted that because of what they can see is genuinely retiring. One of their key questions was, is he definitely leaving the workforce? So if Ron was going to go off and do some work for somebody else or start up something else, he might have more difficulty with that. So, but if he's ready to put his feet up and go off and spend his time fishing and just enjoy his retirement, then that's where this definitely works, and again provide a very tax-effective outcome. Something to consider is if you're selling the business, and it can, in the 15-year exemption, it's less critical to sell the shares. Selling the business can still work. And if that wasn't going to work with Ron, then we're considering potentially having Diane retire from her employment, and she could be the one retiring, and Ron could receive concessions as Diane's spouse. And that was another option that could have worked, but it doesn't. So this one works anyway, but there's a few things that you can consider if you're faced with this scenario. Okay, so we're up to the questions. So the first question that came up, Caravan Park. The question when I was talking about active assets, the question was about Caravan Park. Is similar. Now there was a case about a caravan park, but generally, in theory, yes. If you think about something like a boarding, I mentioned a boarding house. If it's in that sort of nature, you would think there'd be an argument to say that something like a caravan park or any other types of holiday accommodation could be accepted as being not more active rather than rental. The issue with the caravan park, it was I've got the name of it in front of me at the moment. It's a relative, but it was the case that actually ATO did have an issue with that not being accepted, and the main reason their arguments were, and that went to a tribunal, I think, but that certainly didn't. The ATO did win that decision, and despite the arguments of that there were meals provided, there were some other services being sort of provided. They were fairly fixed. It was sort of longer. It was potentially it was a fairly fixed sort of thing. It wasn't sort of like just drive up your caravan and hook it up there. It was a much more substantial operation than that. Also, fixed sort of arrangement with the Caravan Park, but you could go and stay there. But yeah, they did hold that it was more in the nature of the similar facts to what I went through before. They did hold that it was more in the nature of rental. So even relatively short-term rental can still be rental. And so it's one of those things that can be quite subjective, and I think you'll find that the facts could perhaps turn the decision, and you might look at different decisions and perhaps think they might not always be completely logical. But yes, I would look at Caravan Park similar to perhaps the sort of boarding house, and that sort of accommodation area, can be a bit tricky. So I'll go into the next one was about units and unit trust. Yeah, so when we're talking about shares in a company, it's fair to say that that units in a unit trust pretty much have the same effect. There are the rules around grouping of unit. It does actually mention fixed trusts, but yeah, for all intents and purposes, you can trace through ownership through a fixed trust. So it's pretty similar to the shares. I talked about discretionary trusts specifically because obviously the nature of those are different. It's not so easy to attribute ownership, and we all deal with just family trust, discretionary trust so often that you really need to be aware of those tests. They're more complex to apply. But yes, the answer to that question. So we have another question here. If turnover is over 2 million, can you split companies so each company is under 2 million, sell the company that has lower turnover, while meeting the net assets under 6 million? So look, if you're using, there's probably a couple of ways to look at that question, but if you're going to use the 6 million test, then you're going to consider the turnover. That's the first thing I'll say. So it's a bit of an either or thing, and but the other probably important point to make is that selling shares in a company now it's since the 2018, it's particularly since the 2018 changes, is pretty difficult if you're selling shares in a company to apply the $2 million turnover test. And the reason for that is that the taxpayer, being the owner of the shares, needs to be carrying on a business immediately prior to the sale. So you would need the situation, which is not that common really, to you need the individual shareholder to be carrying on a business, and then okay, they're a small business and they meet the turnover. The turnover of the company also has to be under 2 million, which didn't used to be that necessarily used to be the case. But the and then the business, they need to have a business. The individual has to be carrying on a business less than 2 million turnover, but that has to be in place before for the sale, and also not be a contrived, or it sort of does follow. It shouldn't be a contrived arrangement. So realistically, it's a very difficult thing to do. So before you even get on to things like when you talk about splitting companies, if they're connected, there's an aggregation of the 2 million as well. So if they're connected entities, if they've got common ownership, then even if you try to split companies in whatever way is envisaged there, they're going to get aggregated anyway. So that really won't help with the $2 million test. But I think the fact that the individual shareholder has to carry on a business is generally the biggest problem. So I don't find it useful. That useful. As I said, the most best example I've had is where the farmer owns the land and it's just a sole trader, because you don't have the same problem. They're clearly carrying on a business individually, and so that works really well. That was an accountant, a rural accountant who I assisted with that. I can't say I have that many clients who are in that situation myself. We have some clients with primary production activities, but not as many. And yeah, so most of the business structures we're dealing with are not like that. So it doesn't quite work that way. Now we've got a question about Ron's situation. So could Ron wait and sell his shares after Tammy is out of scope for prior year distributions? Yeah, definitely. And that's probably one of the lessons of that case study, is that he would not have certainly that marriage didn't end well, and it's definitely, he wouldn't want, the last thing he would want is for Tammy's and his and Tammy's financial affairs to be mixed up together. And so that's one of these things where the more you know about this and the more you plan ahead for your clients, then the easier it is to get the right outcome. So you're absolutely right. If Ron knows that's going to be, or you're Ron's advisor and you know that's going to be an issue, you can control the timing of that, and that should hopefully sort that one out. Now, there was a question around the turnover test in context with the $6 million asset holding test. So can I elaborate on that? I think I've sort of done that earlier, and hopefully maybe Tim, you can tell me if that's a comment, if you think there's anything more you need to know on that point. But it's yeah, the best way I think of it is the $2 million and turnover and $6 million assets are generally separate. Okay, so this is a slightly longer question. I'll just try and address this one at least. A shipping business in company owned by two shareholders 50-50 is sold. The net asset value turnover test is met. Well, as I said, you only need one of those really, but that's fine. All concessions except 15 million are available, 15-year, sorry, are available, and client chooses a retirement concession. What happens if the accounting gain is higher than the tax capital gain? So, right, so the tax capital gain is $1 million. The accounting gain is 1.2. So each member uses a retirement concession of 500,000 is paid out to super fund. What happens to the excess 200,000 capital gain? Right, so you're trying to get that over. Okay, so these are funds within a company. So the business in the company is sold. So, right, so I can see the point there. So that, yeah, so the point about the retirement concession is, and I didn't really elaborate that in detail, is the retirement concession. The limit is, as has been pointed out in this question, the retirement concession. Each individual has a $500,000 limit. So we have two members, say husband and wife, who each get the 500,000. Then you can get it $2 million out tax free. That's correct. If there's accounting gain which somehow exceeds the tax gain, or even if there's an excess gain, if there's more of a gain in excess of that, then yeah, you're left with the only way that can be paid is through a dividend. That's correct. I mean, either there's somehow a difference between accounting and tax, and therefore there's excess profits that will have to come out, and then the question will be, are there franking credits to cover that? If you've got a difference between tax and accounting, maybe there are excess credits somehow, and then it all balances itself out. Or if there's simply, to vary the question slightly, if the capital gain was in the end was 1.2 after applying all the concessions, then you might have money you'd have to pay out, and that there's a related point there, that if you're selling the business, then the active asset concession amount is tax free to the company, but can only come out tax free as a dividend, or as a dividend with potentially unfranked, or as a capital payment, which would then be subject to, perhaps it'd be capital or liquidate, and then you would need to liquidate the company, and you may get some concessions on cancelling the shares on liquidation, but there'd at least be some tax leakage. So that would be if we needed to go, it'd take a little bit longer to go through that in detail. That's almost a separate example, which I haven't really specifically covered in here. So I'll just try and get a couple of these other questions quickly. So where goodwill is owned by a family trust and being sold with the key person performing the income generation, but not an employee, will the 15-year exemption still apply? Okay, so yeah, well, it's not, they need to be retiring. And when I say they need to be retiring, it doesn't mean they need to actually be an employee. It's probably more that they need to be retiring probably in a broad sense. So if they're still working, and that might include if they're not carrying on this business in that sense, because if they're selling it, if they go and start up another business, then perhaps that's not really retiring. So you'd have to be very careful about what the person is doing, and so yes, it's ideally they simply be stopping work at all, and if they're planning to do something, you have to be very careful about that and think that very carefully. And so next one, in the case of a sale of business by a company and the active asset reduction. Okay, this is the point I was making before, which was I didn't realise was in a question. So yeah, so the person that's saying this is correct. So as I was starting to explain before, that it's not always easy claiming the active asset reduction in a company when the company sells the business, because there isn't the ability to pay it out easily. If the numbers are small enough, you can choose not to claim the active asset reduction and just put a higher amount against the retirement exemption, and that's the easy way to get it out. But if you're selling for $3 or $4 million, then that may not be an option, may not be a very satisfactory answer. But the alternative to the best alternative to paying that amount as a franked dividend is to clear up the company, and then well, they can pay dividends over a period of time, and maybe when the marginal rates are a bit lower, but also clear up the company and liquidate it by liquidating that untaxed active asset reduction amount comes out as a capital payment, similar to sort of similar to a pre-CGT reserve amount for when they've sold pre-CGT assets. And I'm assuming that the shares are post-CGT, otherwise it would be much easier as well. But assuming the shares are post-CGT, then you'll have a capital gain on cancelling those shares, but some of the capital proceeds will include the active asset amount. So you could actually apply, if those shares are active assets, you could apply the concessions to the sale of to the cancellation of those shares and claim, as well as the CGT discount. Then there'll be some other you claim some of the active asset concessions to that as well. So there's a couple of things that could be done there. Yeah, and the unit and the question, the part of that question was, is if it's a unit trust, is the same is it the same if a unit trust sells units and claims asset reduction exemption? Well, you would get a essentially you would get a CGT event E4, which is where a unit holder receives a capital payment, and so it can certainly give rise to a capital gain. So it's not necessarily winding up the trust, but it would be if it's a capital payment, or if you're winding up that's so it sort of becomes it's a slightly different analysis, paying amounts out of a trust to liquidating a company, but it gives you a similar outcome. So it's something that definitely needs to be planned carefully and carried out carefully. Okay, so can sale of businesses and land of one huge dispatch centre be considered an active asset? That's a very big question. I don't know, I've advised on a transaction where we were, someone had a really, wasn't exactly that, but it was a very large facility that applied, when we had to apply some of those similar principles that I discussed before on the active asset and the ATO's determination, and it's very much analysing the facts and looking at the activities and trying to show that not only that it's a clear business, if it's a huge facility and or centre and the activities are quite active, you could probably show that it's active. Then it's a question of if there's rental showing, and certainly that was the case with the example I was helped to advise on. It's whether that's rental, whether that you can show that it's not rental income, and then applying those various factors becomes a bit tricky there as well. So very, very, very fact specific, that one. So dad holds farming land held by individual, 30 years. Okay, business originally operated in mum and dad partnership for 20 years. But now a trust operated by the sons runs the farm and pays a hire and lease charge to the partnership. That is the trust's appointer. Okay, so yeah, so you need to look at the facts a bit more carefully, but you said the sons operate the trust and run the farm, but you're looking at so dad is the appointer. So again, I know there are different people have different views on the role of the appointer in this situation, but you're looking at who you've got to look at the specific definition and what makes it a connected entity. And there's certainly arguments to say that if dad's sort of the one calling the shots and Jim simply being the appointer, it might be that the sons are calling the shots and he isn't that involved. So it's certainly possible the ATO could argue, well, they're not really, dad's not really that involved anymore in the trust. So it's certainly not an automatic connection, but you're wanting to show that dad's still got a reasonable amount of control over the trust. to even if the sons carry out the day-to-day operations and maybe receive most of the distributions, so that it is a connected entity. So and therefore the dad who owns the land is still going to be connected with the trust, and that's how you will get the concessions on selling it. And someone's followed up, so does he meet the 15 years? Well, if it's been active, it's been active for 15. Yeah, so I guess it may be, yeah, you might get 15 years. So it's at a point in time, and so you probably got to look at the pattern as well, not just the right now. But certainly, yeah, there's definitely possibilities there, but you need to look at it carefully. And someone's asked about the $2 million turnover test in relation to other SPE turnover thresholds. It's a very good question, because there are a number of different thresholds, as I'm sure everybody knows. There's the $50 million which applies to a lot of purposes for the company tax rate. There's the $10 million turnover test for a lot of small business concessions, but there's absolutely no increase to the $2 million turnover test for Division 152 for the small business CGT concessions. So no, despite the fact that there is 10 million and 50 for other purposes, it's still 2 million for this purpose, and there's no indication that will change. Okay, so company has sold assets rather than sale of shares. We've got less than $2 million. Does the company need to have it active for ABN for the 2-year exemption? Well, so look again, I guess the sale. So I guess because the company is making the sale, so yes, it could. Well, having an active ABN doesn't necessarily. It's got to be carrying on a business, and that's actually an important point with the carrying on a business can be a very broad term, but certainly needs to be carrying on a business in order to satisfy the the $2 million test. So having an active ABN will be an indication of carrying on a business, but there's a lot more than that to say. So Tim's asked a question around in the last one about the 80% test. So I might have elaborated a little bit on that. I was trying to get to. So and in fact, I think perhaps hopefully I have touched on that a little bit, but it's again, it's all about having not having non-active too many non-active assets in the balance sheet. So a lot of the time we don't have that. As I said before, it's the excess cash, which I think is probably less likely to be an issue, but it could be. But certainly the debit loan accounts to me are the most common situation. So just need to look at those things and with the 15-year exemption, looking at that. It might not be a problem now, but was it a problem 10 years ago? Were there a period of 8 years, something where they had large debit loan accounts that might rule them out of satisfying the 80%? And that also requires, say, 10 years ago, putting a valuation of value on the goodwill. You might be able to say what the business is worth now, especially if it's an external sale. But what was the goodwill worth 10 years ago, or even a property for that matter? So that's if you haven't actually got a valuation, that would be more difficult. But that's the sort of thing they're basically looking for in order to justify it. So the best situations are where you just don't have those anything that would threaten this 80% test. Otherwise, you're relying on being able to convince the ATO that it would have been okay. Okay, so the last question I've got here says, under the liquidation of a company, in order to get this active asset exemption on the cancellation of shares, doesn't need to happen within 12 months of sale. Not necessarily. In fact, so it would the exemption would. So you would, again, there could be there's different steps there. So when I talked before about trying to pass that, pass out this may not be exactly the question, but trying to pass out the tax-free amount out of a company. So you might have claimed the active asset exemption originally, and that will be exempt in the company, and that's fine. it only becomes an issue when you try and get that money out. So as long as it sits in the company, it can sit there for a number of years even. When you do try and get it out, if you're going to use the liquidation strategy to get that out, you've just got to put the company into liquidation, do what you would normally do in liquidating a company. And it's really on the cancellation of shares at the end, just the same as sort of thing that happens in any say, again, we're paying out pre-CGT reserves or anything that's sort of capital, we're paying out capital. You can pay dividends if there's clearly things that can be paid as dividends, and you might do that before you start the liquidation. But liquidations sometimes do take longer than 12 months, and there are actually rules around when normally you would get a CGT event C2, the cancellation of the shares on the liquidation, but there's also a G, I think it's G3 or G1, one of the G events that applies when companies are being liquidated, when you've got an interim distribution by liquidator. So you might get that situation, but if it's being within a certain time period. But ideally, you would plan this. It's no strict 12-month time rule or anything, but ideally you would clean up the company as much as possible and have a fairly simple, orderly liquidation that might not take too long. Just get that would be the way to get the rest of the funds out. And you're probably taking the profits out before that as dividends to make the liquidation as simple as possible. I think probably wrap it up there. And Tony will obviously happy to Tony will give a little bit of a closing, and then we can talk. Obviously, you might reach out to us separately. So Tony, back over to you. Thanks to everybody for your attendance and for all the questions and input.
Yeah, great effort. Thanks for getting through all those questions, Pete. Greatly appreciate it. It was a bit of a marathon, but well worth the time. I hope you found it useful. Great having you with us today, and we'll reconnect in the new year. But likewise, feel free to reach out to us. Thanks very much for attending.